Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, January 24th, 2024. I hope everyone's having a good day out there. It is a little overcast here in Colorado, not quite the sunny, beautiful weather that we're normally used to, but it's not, below zero, so, we'll take the winds where we can get them. Hope you're having a great day out there, and, kind of a mixed market. Looks like lost a lot of its strength as the trading day went by. And looks like the Dow finished in the red, unfortunately. So anyways, if it is your first time watching Liberty Call, if you would do me a favor, if you give me some thumbs up, like, share, subscribe, follows, and press the notification bell. Let's go ahead and get into today's numbers and see how they turned out. Like I said, the Dow Jones was down 0.26%, 98 points, closed at 37,806. S&P 500 was flat, up 0.08%, closed at 4868. NASDAQ up 0.36%, closed at 15,481. The VIX was up 4.3% today. It's back up to 1309. Canada was down 0.04, Brazil down 0.35, and Mexico down 0.15. So it looks like the Americas not the greatest today. Over in Europe, big numbers here. Germany was up 1.58%, the UK up 0.56%, France up 0.91%. The Netherlands was up 2.43%, Spain up 1.16%, Italy up 0.87%, Switzerland up 0.43%, and Portugal up 0.93%. Russian exchanges were both red today. The MOX down 0.42% and the RTSI down 0.53%. And the Asian markets, the Nikkei in Japan was down 0.81%. Australia was up 0.06%. New Zealand right now is up 0.1%. In China, the Shanghai was up 1.8%. The Shenzhen component up 1% flat. China A50 was up 1.28%. DJ Shanghai up 1.6%. Hang Seng up 3.56%. And the Taiwan weighted was flat, up 0.01%. So like I said, Asia and the European markets were just jumping today, not so much here domestically. All right, well, let's go ahead and hop into the market recap, see what happened there. U.S. stocks rise as Netflix surge powers bullish bets on tech. Tesla earnings are eyed. All right, U.S. stocks extended their record-setting streak driven by a surge in Netflix, which reported robust subscriber growth in Q4. Netflix's addition of 13.12 million users during the quarter, a 71% increase year on year, surpasses estimates and lifted the stock by over 11%. That was probably because they went and changed their app where you couldn't have 10 people using the same Netflix subscription. So I think that's probably what happened was a lot of people who, you got, 4 or 5 kids and their friends and everyone else subscribing, and they've had to curtail that a bit. And that's probably why their subscription base went up. Despite a slight miss on earnings per share, the company's optimistic outlook for a healthy double-digit annual top-line growth contributed to bullish sentiments from Wall Street analysts. Tesla, set to report after the market close, was expected to forecast a 21% increase in deliveries for the year, signaling challenges amid intensifying competition in the electric vehicle market. Chip stocks led by AMD surged over 2% after New Street Research upgraded AMD to buy, anticipating increased chip demand driven by the AI revolution. ASML Holding reported Q4 results that beat expectations, causing its shares to rise over 10%. But Texas Instruments struggled after providing weaker than expected guidance. On the earnings front, AT&T stock fell 3% as the telecom giant projected annual profit below market estimates, citing lower equipment values and competition from cable operators. DuPont de Nemours slumped 13% after announcing an expected fourth quarter loss, while Kimberly-Clark fell nearly 5% due to fourth quarter sales missing market expectations amid choppy demand for consumer goods products. Abbott Labs saw a 2.5% decline in its stock after reporting lower than expected sales in its pharmaceutical units. Treasury yields edged higher ahead of the U.S. PMI data, supported by strong manufacturing and services data for January, indicating underlying economic strength and reducing the urgency for Federal Reserve rate cuts. Investors are awaiting fourth quarter GDP report and December's personal consumption expenditures data for potential impacts on the Fed's future decisions. And we'll get to that in a minute. All right, so looks like a bunch of pharmaceutical companies aren't doing nearly as well, probably because people just aren't taking as many drugs right now. I guess they need to, maybe have everyone get sick with a cold. Maybe that could help the pharmaceutical companies, because you can't have these people starving. I mean, they got to eat. All right, next up, U.S. business activity picks up in January. Inflation is cooling, S&P Global survey. All right, in January, U.S. business activity displayed a positive trend with a notable uptick in the composite PMI output index, reaching 52.3, its highest level since June of the previous year, according to S&P Global. The index, which tracks manufacturing and services sectors, rose from December's 50.9, indicating expansion in the private sector. The flash manufacturing PMI surged to a 15-month high of 50.3 in from December's 47.9, while the services sector PMI climbed to 52.9, the highest since June. This robust composite reading aligns with economists' expectations of continued but moderate economic growth in 2024. Moreover, receding inflation in the survey supports predictions that the Federal Reserve might initiate interest rate cuts in the first half of this year. But remember, we covered an article either earlier this week or last week that's one of the Fed governors was expecting that it actually will probably be in the second half of 2024. However, companies reporting increasing delays in acquiring materials, contributing to a positive rise in raw material prices. These delays were attributed to challenging trucking conditions caused by storms and transportation delays. Manufacturing lead times also lengthened for the first time in over a year. Despite these challenges, the survey indicates resilient economic growth and diminishing inflation. S&P Global Market Intelligence Chief Business Economist Chris Williamson emphasized the need to monitor cost pressures closely in the coming months. The Flash Composite New Orders Index rose to a 7-month high of 52.2 in January, reflecting an increase from December's 51.2. While private sector employment continued to grow, the pace slowed down. Companies attributed the recruitment efforts to meeting increased business requirements and hiring skilled workers for long-held vacancies, but noted constraints due to labor shortages. As the government prepares to release the fourth quarter gross domestic product estimate, economists anticipate a 2% annualized growth rate following the 4.9% expansion in the third quarter of the previous year. All right. So, business is still trucking along pretty good. So we haven't seen a decline there yet. But, if things hold to true to form, I imagine things will start slowing down sooner than later. Okay, next up, U.S. dollar falls ahead of GDP inflation data, and the Fed is in focus. U.S. dollar experienced a dip on Wednesday, pausing its recent gains as investors consolidated positions and awaited economic data and Federal Reserve policy meeting. The currency recovered some losses after data indicated an uptick in business activity in January, accompanied by a decline in a measure of inflation to its lowest level in over 3.5 years. Investors are closely watching upcoming economic indicators, including Thursday's first reading of the U.S. GDP for Q4 and Friday's personal consumption expenditures data. Analysts suggest that slightly higher U.S. rates may provide support for the dollar, considering the market's recalibration of expectations for rapid Fed rate cuts. Again, why is everyone assuming that rate cuts that they're going to just slash rates? We are back to normal, people. These are normal rates. They were held low for like a decade or more after the mortgage crisis back in 2008-09. And where are they going to push them down to? Because normally under normal circumstances, if the economy goes into some sort of, downturn or whatever, that gives room for the Fed to, cut rates a little bit, to help boost the economy during, while things are lagging a little bit, and then push them back up when things get back to normal. But if they're already back down to zero, there's nowhere to cut. You can't, I guess you could have negative interest rates, but that's not a good thing either. All right. The dollar slipped 0.2% to 103.26 after reaching a 6-week peak on Tuesday, but it has gained approximately 1.7% since the start of the year. Futures traders are currently betting on 5 rate cuts of 25 basis points each for 2024, compared to 6 expected 2 weeks ago. The Fed is anticipated to hold interest rates steady at its upcoming meeting. So if we have 5 cuts at 25 basis points each, that means we're going to go from we are 5.25 right now down to 4. Again, that's not obscenely low, but why should we expect that? I don't know. All right. The euro saw a 0.3% rise to $1.0885, rebounding from a 6-week low, while the Japanese yen gained 0.5% against the dollar to 147.58. The Bank of Canada kept its key overnight rate at 5%, expressing concerns about underlying inflation, but shifting focus to potential rate cuts. The US dollar rose 0.2% against the Canadian dollar to 1.3486. In cryptocurrencies, Bitcoin increased by 1.8% to $39,875. Yeah, Bitcoin had been up to about, 46,000 just a week or so ago. And it's lost a bunch of momentum ever since the SEC decided or approved ETFs to hold Bitcoin. So that's a little odd. All right, one last article here has to do with rate cuts. Investors temper U.S. rate cut bets as Fed meeting is looming. All right, investors are reconsidering their expectations for how quickly the Federal Reserve will cut rates in 24, influenced by a strong U.S. economy and pushback from central bank officials. While investors still anticipate rate cuts, questions have emerged regarding the timing and pace of Fed moves. The S&P 500 reached record highs, gaining over 24% in 2023, driven by expectations of a more accommodative monetary policy. Well, unfortunately, in 2022, it lost basically everything, and it's flat from the beginning of 22 to the beginning of 24 is pretty much a flat line. Excuse me. The dovish shift by the Fed in December has reinforced expectations of the end of the tightening cycle and forthcoming rate cuts. Yet recent comments from several officials have countered the perception of imminent easing, emphasizing the need for more evidence of inflation returning to the 2% target. Investors are now projecting the first interest rate cut in May instead of March, with a reduced probability of a rate cut in March. Of a rate cut at the March meeting, down from 88% to 41% in a month. The resilience of the economy, evident in December's retail sales and consumer prices exceeding expectations, has contributed to the shift in expectations. The Goldman Sachs Financial Conditions Index indicates eased financial conditions, posing concerns that loose conditions could prompt the Fed to maintain elevated rates to prevent a rebound in inflation. And that is a big fear out there among a lot of economists. Despite the stronger economic data, stocks continued to climb, although their ascent has slowed in January. The S&P 500, up 4.4% in December, has gained 1.7% this month, driven by a rally in tech and growth stocks. With optimism potentially challenged in the face of accommodative financial conditions, the Deutsche Bank analysts suggest it may be challenging to sustain the current market optimism for an extended period. The dollar index has risen 2.3% in 2024, reaching a 1-month high after touching a 5-month low in December. All right, so like I said, the journalists out there have finally come to the realization that the Fed is probably not going to be as accommodative as big business and Wall Street would like. But, my hypothesis, and again, this is just, tinfoil hat theory, is that the Fed is waiting for some sort of, catastrophe out there, whether or not it was the dot-com bust in 01, the mortgage crisis in 07, 08, or 08 and 09, or COVID in 2020. They need a reason so that, as opposed to just lowering rates, because then if something bad happens after the fact, then everyone's going to point at them and say, what did you do? Why did you do this? Y'all are supposed to be there to protect us from, more inflation or whatever the case may be. So I imagine they're going to wait for, unemployment to pick up or some sort of a, market crash or something like that, so that they're the heroes and can come, at that point, even if it gets worse, after they lower rates, they can say, well, we tried, we did our best, and eventually it's going to turn back. I mean, usually if you cut rates and do a lot of quantitative easing, money printing, it's going to boost the economy for a while. So they're going to look good regardless, in my opinion. So, all right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.